with today's webinar. Welcome, and as Christine has already suggested, Happy New Year from me here at this end in a wet but no longer quite so cold England. Welcome to Alan, Andrew, Christina, Edwin, Yelena, and Tanya. You've all got your sound activated now. Usual rules of engagement. Some of you have already used the chat box in theory, but maybe not in practice. You could speak to me directly. I would need to open your microphone for that. And as you all know, we tend to leave that possibly until the very end of a webinar if needed, because it reduces the bandwidth. We've got 4 multiple choice questions for today, and of course I will be delighted to hear from any of you after the event by email. I'm going to kick off with just a very quick news update of ISB publications, and for many of you who practice here in Europe, an EU endorsement update. But then the theme is, of course, IFRS 15, revenue from contracts with customers. Some selected areas, especially the 5-step model. We're not going to do some of the preamble that I did with you a year and a half ago, things like the definition of a contract and a definition of a customer and things that are in scope and so on, because that's fairly straightforward. So ISB publications, there's been the annual improvement process, so-called 2015-17, was published just before Christmas, but after our last time together, and that includes some amendments to IFRS 3 and 11. That's simply confirming that if you obtain control, having perhaps had joint control in the past, then that would trigger the remeasurement process of IFRS 3 to calculate goodwill and so on. A little amendment to IAS 12, which is of no great consequence at all, is in fact a clarification related to dividends. And an amendment to IAS 23, which I believe most people would probably have done anyhow, which is to confirm that if at the end of a specific project that was financed by specific finance, if at the end of that project there's still a balance remaining on that specific finance, it then gets rolled up into the general finance for computation of a weighted average cost of capital for use in a capitalization calculation. And then there were some very narrow scope amendments to IAS 19 that were published just a month ago. Amendments that confirmed that after a so-called plan event, now, a plan event is, for example, either the settlement of the plan's obligations to pensioners, or perhaps a significant curtailment, or equally enhancement. After a plan event, which of course could occur on any one day out of 365 in the year, there are the assumptions that are used in that calculation should then be used for calculating, for example, current service cost for the balance of the year. Again, something which probably would have been common sense anyhow, but it's now formalized. We had an endorsement on the 8th of February 2018. That was the annual improvements, so-called 2014-16. And then we had an endorsement just a week ago which were the amendments to IFRS 2, which clarified certain matters relating to cash-settled transactions. Just a quick update on, particularly for those of you who, many of you who practice in the EU, it's always important to stay on top of EU endorsements. Welcome also in the last couple of minutes to Vesna Mitrovic. Okay, so we're going to focus on IFRS 15 today. We're going to cover basically the five-step model with a variety of questions, illustrations, and some multiple choice questions. I have included in your slides, but I'm not going to cover today, the issues that arise when a contract gets modified. The issue being whether or not the modification is treated as a separate standard new contract, or whether it's part of an existing contract and therefore potentially some sort of revenue catch-up journal. We are going to cover contract costs, but again, really focusing on the incremental cost, and a couple of comments about transition. Like goods and services places a performance obligation, or perhaps even more typically nowadays, modern business, a number of performance obligations to deliver goods and or services, often described as deliverables. Revenue is recognized in a manner that depicts that transfer process of deliverables to customers. And the amount is to be a reflection of, so it'll be consideration divided up, a reflection of the consideration that you expect to be entitled to in exchange for delivering those deliverables. It involves a five-step model. Customer. Now, that's something that we're not going to cover in any depth at all today. The separate performance obligations, price the transaction as a preliminary to step 4, where you then dish out that price to the underlying performance obligations. And then the final step, recognize revenue when. Now, that word would imply an instant in time, or implying a continuous process of performance obligation satisfaction. Probably worth reminding you that the standard describes accounting for a single contract, but as a practical expedient, it can be applied to a portfolio of contracts that have similar characteristics. And from an evidential perspective, important to all of you as auditors, you will expect your client to provide you with an illustration of how to apply the standard to, say, a collection of 10 contracts, and then apply to each individual one, and demonstrating that there is no material difference in the result. As accountants, I remember doing this many times 30, 40 years ago when I was a trainee. We're good at finding workarounds and applying a generalized model to a collection of transactions that gives rise to a perfectly good result. Maybe not precisely the same as we would have had with individual application, but quite reasonable. So step 1, and the reference here is to paragraph 9. The general IFRS 15 model applies only when or if A, the parties to the contract have approved And the standard recognizes there can be a variety of ways and processes in which that carries on. But the critical thing is that there is apparently, therefore, a commitment to perform. Secondly, the entity, here we're dealing with, of course, the seller, the subject matter of the revenue. The entity can identify each party's rights regarding goods and services. The seller can identify the payment terms for those goods or services. The contract has commercial substance, and it's probable that the entity will collect the consideration to which it will be entitled in exchange for the goods or services. It does not meet all of those criteria at inception, then an entity continues to monitor that position to determine when, perhaps, they subsequently are met. So, before the criteria are met, has to be accounted for as a liability, and then that consideration would be later recorded as revenue. He has received substantially all of that price. The contract has been terminated, and the consideration as a question of law is non-refundable. On commercial substance and collectability. Commercial substance, of course, is described in other standards as well, in our suite of IFRS standards, as being risks, timings, or amount of future cash flows are somehow different. Risk, timing, or amount of future cash flows are expected to change. And collectability, an entity must consider only the customer's ability and intent to pay consideration when collectability is probable. Identifying the contract. I'd say we've skirted around things like the definition of a customer, the definition of revenue, definition of contract, and so on. I think for most of us, that's fairly well accepted and understood. First question: when a contract with a customer does not meet the definition of contract because of failing to meet the criteria of IFRS 15 to be accounted for under a standard, but money has already been received, and four choices there, and you'll open the polling panel. Okay, I'm going to suggest that we close that poll in 10 seconds time. Good. 5, 2, 1. Save the results. What's happened there is that a couple of you have answered A, which is fine, except that my solution A hasn't given you any mechanism with that liability recording at a later date. Quite honestly, as it stands, that sentence suggests it's forever and ever a liability. Slides, you'll see that it is a liability initially, fine, but then is recorded as revenue either because nearly the whole of the price, or the contract has been terminated and the consideration is non-refundable. And that's what one of you answered right towards the very end there. The correct answer, because there has to be a mechanism of dealing with this initial recording of a liability at a later date. So, sure, but then recorded as revenue, either when you've received substantially all of the price, or the more likely outcome, which is why I focused on it, that the contract has been terminated, but it's clear that the consideration is non-refundable. See a reference to, is it your year end and we're about to approve the financial statements, totally irrelevant to it. And D suggests that management can design some sort of judgment process and apportion some of it as revenue and some of it as liability. That is unlikely to be true. To one of you who got it right, and two of you, I can understand why you've answered A. The problem with A is that I've not described any mechanism to deal with that liability. Apparently, it could stay there forever, which is not what the standard requires. Involves identifying what have you promised. At completion, assess the goods and the services promised and identify as a performance obligation each. At inception, it's not something that you can undertake because it happens to be your year end next week and your auditors are about to arrive. So you know, how am I going to deal with this? This is something that should be done up front as part of the model for a particular transaction with customers. When are you going to recognize revenue? Involves a simple question of what are the promises. Either a good or a service or a box, a parcel of them that has the characteristic of being distinct. Now, I need to focus on that in a moment. Or alternatively, there is a series of repeat performances of the delivery of, again, distinct goods or services. And the thing is that repeat performance is basically genuinely a copy and paste, a substantially identical, with the same sort of pattern of transfer to the customer, and that would be described as part of the process, potentially, as we'll see, of describing a measurement of the progress made to completion. Meant by distinct. The word that springs to my mind, with my economics background from many years ago now, is the idea of utility. Distinct if the customer can gain utility from it that the customer can be presumed to have. So, for example, when you sell a Mars bar, one of those big chocolate bars, to a customer, presumably he's got teeth and he can bite into it and enjoy the Mars bar. If he doesn't have teeth, presumably you'd have to sell him some false teeth and the Mars bar for him to gain utility from those goods or services. So a good or a service is distinct if both are met. The customer can benefit from the good or service either on its own or together with other resources that one can expect that the customer has, and the particular promise is separately identifiable, remote from other promises made in the contract. Not rocket science, because if there is a good or a service that is regularly sold by you or others in your industry as a separate item, it means that customers can expect to benefit from it. I mean, if it is the case that Mars bars are only ever sold with false teeth, then presumably it's because everybody who eats Mars bars, well, maybe it's too many Mars bars, have got no teeth to enjoy it. So if you sell Mars bars separately, it's presumably because people generally do have teeth in their mouth and they can enjoy it. Apologies for a slightly stupid example, but it brings to my mind the simple idea of, can the customer benefit from it, either on its own or at least because they bring some suitable other resources to the table. Indicators. The entity does not provide any significant service of integrating it into goods or services that represent the combined output. So, for example, the customer is probably a fully equipped garage of his own, is probably not going to be very helpful without also selling him fitting that tire to his car. Good or the service is not highly dependent on or interrelated with other goods or services. The customer is perfectly able to say yes, no, and choose whether they buy that good on its own or together with other promised goods or services. Take it or leave it. The customer has got that freedom to take it or leave it. Then presumably it's a fairly distinct item. Or service does not significantly modify or some other good or service. Let's have a look at an example. To software license, install the software and provide 2-year hotline support. X regularly sells the license, installation, and technical support quite separately. Service is routinely performed by others, and it critical here, it does significantly modify the software. Remain functional, the best it could, but it remains functional without the technical support. Benefit from the goods, but yes, the software is delivered before the service. The software remains functional without technical support. Promise to deliver the goods and the services separately identifiable from other promises. And the answer is, well, yes, there's license, there's technical support. Conclusion, the performance obligations. A performance obligation for the transfer of the license, a performance obligation for an installation service, and a performance obligation for technical support. Now, coming up later, the implication will be, therefore, that we take the program deliverable and dish it out to the installation service for technical support. That's to identify the underlying separate, distinct deliverables. Now, let's recognize that this is absolutely no big deal. The license, the installation, and technical support all happened within one accounting period. But these things are spread over. We already know that the technical support lasts over a 2-year period. And it might be that the license gets transferred on the 29th of December and the installation takes place on the 4th of January. And so the issues associated with distinct goods and services really fire up and become critical when there are year ends or other period ends within the total contract time. On that example, X enters into a contract to transfer a software license, install, and provide technical support. X sells each component separately, so on the face of it, it looks like they are distinct. The contract specifies that the software is to be substantially customized in the process. Okay, so we've got something different here. Could be provided by others. Some benefit from the goods on their own also. No, in respect of the software and the installation. Because the software is significantly modified or customized by that service. You can't offer a modification and customization without the customization doesn't perform what the customer requires. So what we're now going to be concluding is that although the technical support can be provided in separately, distinctly, then the software and installation have to be looked at together. If to deliver goods and services separately identifiable, yes, for the technical support and any update, no for the installation. Because service of integrating. So, conclusion here, there are now two. One, for the software license and installation service, and then spread over 2 years for the technical support. So, we from the contract and to add to that our understanding about the way in which a company might do business in terms of its standard behavior. We have to identify whether the goods are distinct in order to identify the performance obligations. In our example here, 1, 2, or potentially 3. Issue when there's a year end somewhere along that process. Now, if a promised good or service is distinct, and here with the integration customization, then you have to bundle it with other promised goods and services until you end up with a single distinct or series of distinct repeat performances. Now, that might well mean that eventually you have to conclude that the whole of the contract has to be accounted for as a single performance obligation. F is a contractor. They enter into a contract to build a bridge. And the overall management of the project. The project involves the provision of various goods, services, steel, concrete, design, foundation, site preparation, construction. F, or indeed others in their industry, regularly sell steel, concrete, project management, and so on separately. And the customer could, academically perhaps, take a delivery of concrete and then turn around and sell it. They could, in a sense, benefit from each of those elements. Or they might say they take a delivery of steel and they say, we think steel is going to triple in value over the next month. They can make an enormous profit out of holding the steel. Not very. However, there is a significant service of integrating the output, a bridge. So, can the customer benefit from the goods, etc., on their own? Yes. X or its competitors regularly sell many of these things on their own. The customer could generate economic benefit by selling, consuming, holding the concrete, the steel, and so on. But is the promise to deliver them separately identifiable from others? No, because there is a significant service of integrating goods into what it is that the customer has contracted for. Build me a bridge. Services are not distinct, and therefore the entity accounts for the whole thing as it's a construction contract. Build me a bridge. In this case, although the customer could gain utility from separate items, the promises to transfer are not separately identifiable from others. The promise at the heart of the contract is build a bridge. Question. It explains the meaning of distinct goods or services. Which of the following statements is true? And I've given you 4 statements. And polling panel. C and D. A good or service is distinct if the customer can benefit from the good or the service and the promise. D says a good or service is distinct if the customer can benefit from the good or service, or. Okay. So that question accurately. Slides. So far, with a good, strong response for the right answer. 5 seconds. In your notes, you need to just look carefully. Okay, close that poll in. 5, 4, 3. Okay, 4 of you have responded and 3 of you have got that accurately right. The correct answer, of course, is C. Okay, customer can benefit and a identifiable promise. Good. Okay, moving on. Step 3. Revenue recorded either when or a continuous process. Performance obligations are satisfied. Reflection of the transaction price that has been allocated to that particular performance. What we need to now address then is the amount of the transaction price, and in particular, that's going to involve consideration of variable prices. And then step 4 is the allocation of that price to the performance obligations. So the transaction price is the amount of consideration to which you expect to be entitled in exchange for completing on one of your promises, excluding anything collected on behalf of, say, government, thinking of value-added tax, or excluding the collection of principal, and that would be in the context of an agent principal transaction. Revenue for the agent is just their commission, not the capital that flows through them. Again, we weigh up the terms in the contract and customary business practice. It might be fixed It might be variable, it might be combinations of those things. It does not include an adjustment for customers' credit risk. In order to compute the transaction price, where there are variables at stake, there are assumptions. And the presumption is that the process will follow in the way that the contract describes it. The contract, therefore, will not be cancelled or renewed or modified in some way. Okay, we're going to visit the hospital. C, a hospital provides medical services to an uninsured patient in the emergency room. C has not previously provided medical services to this patient, but is required by law to provide a medical service to all patients that arrive in the emergency room. Provides the services immediately because the patient is dying. Provides the service before it can determine whether insurance or a credit card or whatever, in particular, before the patient is committed to perform his or her obligations under the contract. So the criterion in paragraph 9A, we saw that earlier on, of IFRS 15 is not met. Okay, we cannot determine whether or not the customer intends to commit to contract. Paragraph 14 applies. C, Inc. must continue, therefore, to assess this contract to determine when or whether the 9 are met, presumably when the patient wakes up. C obtains additional information about the patient, including a review of the service, standard prices for these services, and an understanding of the patient's ability and intent to pay. The standard price for the service is $10,000. The patient's information and its policies, it designates the patient into a particular customer class based on ability and intention to pay. The paragraph 47, which is the terms and customary business practice, and paragraph 52, which deals with what happens when the price might be variable, and in particular, when a price concession may well be offered. C concludes that it expects to receive less. Therefore, the promised consideration is variable. The ability and intent of the patient to pay, maybe it considers a range of prices, but concludes it is probable that consideration of 1,000 will be collected. The contract to exist. The fifth criteria is probable collection of consideration. So therefore the paragraph 9E, the fifth item, is now met. Paragraph 9 are now also met, and the entity therefore accounts for that contract with a price of 1,000 in accordance with 15. Now, variable or price considerations. Variable consideration can arise from rebates, quantity discounts, settlement discounts, performance bonuses, penalties. There's a whole range of ways in which variable consideration might arise, and as we'll see in a moment, there is a particularly important step in to constrain, limit the allows us also to consider time value when there is a significant financing element. So if you sell goods to a customer where the normal payment terms are 30 days and you give that customer 1 year, is a significant financing element. But you know, to what we always used to do under IAS 18. So there's nothing new there. To weigh up whether or not consideration might also include non-cash consideration. I've always done that. It used to be SIC 31, Standing Interpretations Committee. SIC 31 was always part of IAS 18 in the situation of a type of barter exchange. The standard also requires us to weigh up something that might be given back to the customer. For example, similar. And again, we've all under the old standards, it was, of course, IFRS 13. And the answer under IFRS 50 is identical for non-cash consideration and emiles or similar payable to a customer. But what way out is a variable consideration and constraining it. So, prices that are variable, penalties, bonuses for overperforming and so on, because it is recognized, it's going to be booked, but it's going to be booked subject to some limitation on the recognition of variable revenue is that once it's been booked, that revenue should not be subject to the risk of a significant reversal. That happen when the uncertainties resolve themselves. So I'm going to book some of this variable consideration, but in mind that you want to minimize the risk of having to revisit that and reverse previously recognized revenue. Now, variable elements are all opened, dealt with, and closed, finalized within 1 year. It's not an issue for us. The issue comes when there is a variable amount of consideration which is going to get confirmed a year end or period end. To continually reassess that objective as the circumstances and the facts change. So, an entity must include in the transaction price some or indeed all of an amount of variable consideration estimated, excuse me, an expected value. Now, you should all know what I mean by an expected value method, or by identifying the most likely outcome you'll recognize. Historically, it's perhaps often said that a most likely method popular in America, and the expected value method has earned its reputation, perhaps in a sense, elsewhere in the world. Only to the extent that it is highly probable that reversal in the accumulated revenue would not occur once you've resolved the uncertainty. So, variable consideration that you want to bear in mind, you don't want to run a great risk of thereafter having to reverse it. Reversal in terms of probability, the likelihood of, and reversal in terms of magnitude. Both elements of reversal need to be weighed up. There's not much I can add to it. A little list of some of the factors that would affect likelihood and or magnitude. So the amount of consideration is highly susceptible to the weather. The uncertainty is going to go on for years and years. As a company, you've got very limited experience of offering volume rebates, or the experience you do have was a set of circumstances, so is of limited predictive value. Offering quite a broad range of pricing concessions and payment terms and so on, and broad range of possible consideration amounts. Assessment, you need to capture all of the facts and the circumstances, both risk and magnitude, to find how much probability low of reversal you should define. But it is clear if you look at the development papers to IFRS 15, it was intended that you should have a pretty high confidence level. I mean, one's thinking perhaps 90% or higher. There will be no significant reversal. H enters into a contract with the customer to build a customized machine asset. The promise is a separate performance obligation that is satisfied over the passage of time. The promise consideration is 2.5 million, but reduced or increased. And okay, for every day late after the 31st of March, it reduces by 10,000. For every day earlier than the 1st of March, it would increase by 10,000. Additionally, there's some sort of machine performance metric, break, and if the asset is completed within that performance metric, then you get an additional incentive bonus of 150,000. I mean, hopefully what you can see here is we've got quite a range of variability. Approach this situation in the following way. A variable consideration will need to be estimated separately using a method, remember, expected value or most likely, that's going to provide the best estimate, historic, current, and any forecasted predictive relevant information. 1, 2, 3, 4, 5, 6, 7. I mean, it could be a whole range of days, a large population. Perhaps it would be most sensible to use an expected value methodology. So 1 day late, probability 0.01. 2 days late, probability 0.05. 3 days late, probability 0.1, and so on. And similarly early. Now, the performance metric is either a win or don't win. A binary outcome more appropriate methodology to simply ask, is it likely that we would bonus? There are only two possible outcomes, and a most likely approach might be a better way of predicting. Application of the overall constraint, only some or all of it should be included. Discount. X enters into a contract with a customer on the 1st of January to sell product A. Okay, $150 per unit, and the purchase of more than 5,000 units in a year would attract a retrospective price, so everything up to and beyond a price of 140. So a classic debate. So consideration is the conclusion. Quarter one, units were sold. Okay, now you look back at it. The debate gets triggered for 5,000 in a year. It's a lousy 300 units. X has therefore got relevant predictive evidence of similar contracts and says, it's not going to happen. They do not expect annual sales to reach more than 5,000. So the revenue recognized in quarter one will be 300 units at 150. On quarter two, 2,500 units were sold. So unit sales to date, that's for a half year then, is now 2,800. In your head thinking, okay, there's now quite a good chance, based on this current, relevant, predictive information, the discount will be triggered. Or recognized in quarter two, the cumulative at 140, less whatever we booked in that first period. Upwards through quarter three and quarter four. I mean, sure, it does not do quarterly accounting, then they will know for certain that was triggered, and they will record the right revenue. It's relevant if all the uncertainties get resolved within a single accounting period. But if this company accounts, for example, quarterly, or contract started in, say, quarter three of one year, and is therefore going to finish at the end of quarter two the next year, it now becomes an important question. And AS 18 did not answer. And that characteristics of IFRS 15 is that it has answered many unanswered questions from the old standard. Question for you. The transaction price as the amount of consideration that you expect to be entitled to in exchange for deliverables. The sale of goods and services might be variable. With the following statements, it is true. description of the variable consideration constraining approach. Careful reading, and another one. I'm going to close the poll at that moment in time. We've got 4 people have answered, 3. Let me just. One of you answered D. Look at with D is that we're confusing consideration with whether we've had the cash, whether it will be received. That's mixing up credit issues, credit impairment, with revenue recognition. This standard is about revenue recognition. The impairment, the possible lack of receipts, is an issue associated with IFRS 9, impairment of a financial asset. So D is not right because it's mixed up those 2 items. C correctly refers to whether or not there is a high probability that a significant reversal of revenue recognized will not occur when the well done to 3 of you who read it accurately, and the answer is C. To take us up to a coffee break, allocates that transaction price. So the objective is so that we can therefore book revenue at each individual satisfaction of a performance obligation. To do that, we need to dish out the total transaction price. How do we do it? You will perhaps be aware that under the old standard, IAS 18, the way we used to do it was to borrow a bit of US GAAP, and we would share it out on a relative fair value basis. All we're now going to do is to show standalone selling price basis. And you know, quite honestly, relative standalone selling price is hardly any different from fair value. And there are special rules for discounts and variable consideration, which I'll illustrate for you in a moment. Completely irrelevant if, for example, we've had to bundle all of the deliverables into a single performance obligation. Prices are determined contract inception. Again, you're not going to undertake your selling for a year and then get to the last day of the year, adjust your selling prices so that gives you a particularly favourable recording of revenue. It's done up front, which you would sell a promised good or service to a customer. Now, when there's a discount, an aspect of variable consideration then, a discount is defined as when the sum of the standalone prices exceeds the contract price, unless you can show that the discount is specifically related to just one item, then you have to assume that it relates to all of the goods. To all goods, it will get allocated proportionately. Allocated to then one or more, but not all of the performance obligations, subject to 3 criteria. So let's have a look at an illustration. X sells 3 products at the following standalone selling prices. But to sell one of each to the customer, the different instance in time, and the delivery of each product is a separate performance obligation. So, about which performance obligation has triggered therefore the discount has to be assumed to be relating to the totality of all 3 products, and it's therefore dished out. Now, the whole of these 3 deliveries, A, B, C, 3 different deliveries, if they are within one accounting period, academic, the price, the revenue is 300. But the problem comes when, for example, we delivered item A, and then there's a year end, and then it's B and C. Or maybe B, and then there's a year end, and then C. If there is a year end or a period end in this process, the issue of how to dish out the discount becomes critical. And old standard, it never gave us an answer. Already reached your performance target for the year, it was quite acceptable to say, oh well, look, we'll spread this discount over A and B because we've already reached our target, and that leaves C for next year as the highest price possible. You could argue it the other way around. The problem was silent on these things. The difference entirely to one or more, but not all, criteria are met. In other words, this is tracing the discount to a unique part of here, these 3 products. If all are met, each distinct good or service is sold regularly. A bundle or bundles of some of these distinct goods or services sold regularly at a discount. Discounts are substantially the same as in the contract. So let's continue our example. X sells 3 products. Okay, there they are, same as we had before. X agrees to each to Y for a total price of 300. We and C are sold regularly together. That's the discount of 50. Product line, each delivery is a separate performance obligation. So what we've got here is now evidence that the sale of A, which might be before the year end, is to be priced at 100, and it's the sale of B and C together after perhaps a year end that gets priced with all of the discounts. So X regularly sells B and C together for 200 and product A for 100. Therefore, the entire discount should be allocated to the promise to transfer products B and C. So no discount allocated to A, and the whole of the discount allocated to B and C. Fundamentally, again, IAS 18, the old standard, never told us how to deal with those sort of situations. Delivery B and C at the same time, then X could account for that as a single performance obligation. 50 will be allocated as B and C, a single performance obligation, on what happens if there was to be a change in the transaction price after contract inception. The price should be allocated to all remaining performance obligations using the same formula, the same basis as it was at inception. And to performance obligations that have already been satisfied, revenue or an adjustment in revenue. So that transaction price changes. You do not reallocate the transaction price solely for changes in that ratio, that formula of standalone prices. A 5-minute interval at that point in time. I shall mute my camera and microphone. hope some final stage of revenue recognition. Can I need you to understand that this is not something that you can about when you get to the end of a year. This is something that is set as a revenue model at contract inception. This is something that has to be designed and developed and planned for, rather than something that you can sort of make a decision when you get there. So step 5 involves the monitoring of the entity's performance and therefore the satisfaction of performance obligations. Revenue is recognized when, as an instant, or as some sort of process, a performance obligation is satisfied by making a transfer. Now, this is it talks about transferring an asset. If the performance obligation is to deliver a play or a film, the assets that you're delivering are visual images. Instantaneously, the customer is seeing the image, absorbing it, being amazed. So I think the asset, the visual image, may only last for a fraction of a second, but they've done this because we as accountants understand about the idea of control over an asset. So an asset is transferred when or as the customer obtains control of that asset, even if it's only for a fraction of a second before the play or the musical performance moves on. Control of an asset refers to the ability to direct the use of and substantially all of the remaining benefits. Includes, therefore, the ability to limit other people enjoying such an asset. Now, repos, where the transaction never actually transfers benefits to anybody, are dealt with entirely separately. That's the situation where I agree to sell an asset to you, Alan, and I have a little agreement that says I promise to buy it back next month. The question that we have to address at this final stage is whether or not the process is something that happens continuously over time, or is it represented by a deliverable at an instant in time? For each separate performance obligation identified, an entity must determine at conception. Again, just to emphasize the point that I made, this is not something that you can design when you get there. It's something that you build into your model of revenue recognition. Performance obligation identified. An entity must determine at inception whether the entity satisfies performance obligations by continuous process of the transfer of goods. Because if it's not satisfied over time, it must be an instant. So, performance obligations satisfied over time. Again, a very important paragraph. I've given you 3 or 4 paragraph references, but they're some of the most critical paragraphs in this whole standard. First criteria would be that the customer simultaneously receives and consumes. Well, and this is watching a film or watching a show or listening to a musical concert. One possible performance. Or the entity's performance creates or enhances an asset as that asset is being created or enhanced. So building a wall at the customer's property. And the wall belongs to the customer, and you come back each day and put another layer of bricks on. Your work creates or enhances an asset already controlled by the customer. Or you're creating something that is of no value, no use to anybody else, so you can't take it yourself, you can't give it, direct it to a different customer. It has no other purpose, but you have protected yourself with an enforceable right to payment for the work completed. L enters into a contract to provide monthly payroll processing to a customer for a year. The promised payroll processing is accounted for as a single performance obligation. Does the customer simultaneously receive and consume the benefit? Yes. I mean, each month you prepare the payroll, the customer receives the payroll, the customer makes the distribution of pay to employees. The performance obligation is continually being received, consumed, and utilized. It needs to be satisfied. So you don't need to go on looking at the other two possible criteria. X, limited liability partnership, a firm of accountants. It enters into a contract to provide some sort of consulting service with the aim of providing a professional opinion to the customer on facts and circumstances that are unique, they're specific to that customer. It terminates the consulting contract for reasons other than failure to perform. There's a piece of work which is useless to anybody else, but the contract requires to compensate for costs plus a margin. It's consistent with the margin that I typically do expect to earn on contracts. So, does the customer simultaneously receive and consume the benefit? Well, I mean, the benefits of this report is only apparent when the customer receives a completed report. So there is no continuous consumption to create an asset that is controlled by the customer. Apparently, no. Does performance create something that has no alternative use and for work to date? There is no asset that has alternative use. I mean, you can't use one customer's client's consulting and send it to another. You can't sell it as a generic piece of consulting. But critically, the contract gives the right to the contractor to payment for work completed at a commensurate margin. Any successor consulting firm would have to re-perform work to date. The customer receives the benefits only when the report is completed. Work is a useful asset for anybody else, but an enforceable right to payment plus a reasonable margin. Therefore, the performance obligation is satisfied over time. Contract to build an asset for Y. 10% at inception, 50 as a series of regular payments, and 40% on completion. subject to the equipment meeting certain performance tests. The payments are non-refundable. Fails to perform. The progress payments received with compensation if Y terminates the contract. Same as payment for work done to date. This is, a series of discrete regular payments. You can keep what's come before that may or may not be enough for the work that's been done. So, does the customer simultaneously receive and consume benefit? No. An asset controlled by the customer as it's created? Apparently not. Performance create an asset with alternative uses? Well, we don't know. Not an enforceable right for performance. It's an enforceable right to keep the progress payments made, which might even be more than your performance, could well be less. No. X does not have a right to payment for performance completed to date. The payments are non-refundable, but the cumulative is probably not going to compensate for work completed to date. X is not satisfied over time because X does not have a right to payment for completed performance. X does not need to assess whether the equipment would have alternative use. The performance obligation is not. It must be accounted for as satisfied at an instant. Default position in this standard, if it is not continuously satisfied, then it'll be performance satisfied at an instant. To determine the point in time when a customer obtains control of a promised asset and therefore the performance obligation is met, the entity will consider the requirements for control. And I say because we're pretty good. You think of the arguments that we go through about leasing, the arguments that we go through about financial instruments in a securitization process. We understand about control. You think of subsidiary and parent, IFRS 10. We're good at this sort of thing. And so the standard has played to what we're comfortable with, the requirements for control. As additional indicators. Legal title. Possession. We have an expression in England that possession is 9/10 of the law. When a customer says, well, it's in my pocket, it's mine, that's a pretty good indication of control, actually. The customer, therefore, has the risks and rewards of ownership. The customer perhaps has gone through a process of inspection and acceptance of the asset. If we are in the business of some sort of continuous recognition, then methodologies in place for measuring the complete satisfaction. So when goods or services are transferred continuously, a revenue recognition method that depicts the best way possible that performance needs to be applied and updated, amended as circumstances change. That means, therefore, just as you're familiar with from IAS 11, either measuring performance by reference to output, 267 kilometers of road out of a 1,000 kilometer project. 26.7%. It's not magic. So some sort of measurement of output, or you're, I'm sure, also familiar with the idea of using, for example, cost incurred versus total cost, or labor hours to date versus total labor hours. So acceptable methods include input or output measurement. Recognize over time if progress can be reasonably measured. You would do that if available information in order to apply an appropriate method. So in IFRS 15, as it was in IAS 11, that you have a budgeting, forecasting, estimating type process. A so-called cost recovery approach, which might be appropriate at the very early stages of some sort of contract where revenue is booked equal to costs incurred. So therefore no profit, no loss, because it's too early perhaps to identify the likely outcome. Also deals with costs, and in particular, accounting method for all of us, other than in America, is capitalizing the incremental costs of winning business, winning a contract. Subsequent accounting of those costs, which is that they get amortized, perhaps along with the pattern of revenue, and they're also tested for impairment. So those two ideas are new compared. And then something that I'm not going to dwell on greatly today are the so-called fulfillment costs. That's the materials, the labor, the machine costs, and so on, in actually completing the promises. And that must be business as usual. So, obtaining a contract, an entity recognizes as an asset. Okay, this is not a choice. Recognize as an asset incremental costs of winning business. Contract price should ensure that you're able to recover fulfillment costs plus these incremental costs. Classic example will be some sort of sales commission. Costs that you could not have avoided unless they are also, in terms of the contract, specifically rechargeable. Now, is that you can recognize the incremental costs of winning a contract as an expense instantly when incurred if the capitalization and subsequent amortization would all take place within 1 year. And that's kind of pretty obvious, isn't it? I mean, it's over the top to capitalize and then amortize, where that would all take place within 1 year. It's not actually one accounting period, it's within 1 calendar year. Asset recognized under those rules. Okay, we're not talking about inventory, licenses, property, plant, and equipment. That's all part of fulfillment. But these rules is amortized systematically pattern of transfer of goods or services. In that pattern of transfer, then it would be a change of an accounting estimate. Impairment, and conceivably could also be reversed to the extent that the carrying amount of that capitalized cost exceeds any subsequent remaining consideration. Fulfillment costs, my simple answer is business as usual. People didn't quite appreciate that I was called revenue, but it also dealt with cost of sale. And the same is true here about IFRS 15. But it's also about cost of sale. Fulfillment costs, raw materials, processing costs, energy costs, labor, depreciation of equipment, licenses that need to be obtained and so on. All of those would, in the first instance, be recorded as probably inventory or PP&E or intangible. Would only be capitalized if they were uniquely direct and they generate or enhance resources and they are expected to be recovered. If you would expect to be expensing general, admin, waste, idle time, once you've satisfied a performance obligation, then you'll expense cost of sale. Big labor, depreciation, costs that might relate directly to a contract could be bits of labor, materials, cost allocations, for example, perhaps insurance, public liability insurance at a construction site. Any other costs that are explicitly chargeable to the customer under the contract are solely for the reason that you've entered into this. So, out the treatment of revenue, costs. An entity that incurs incremental costs when obtaining a contract with a customer and capitalizes them in accordance with this standard must therefore choices. The distinction that I'm making between C and D is these capitalized costs are tested for impairment from the other assets that are used in your activity, or are they tested for impairment as being a bit like a part of a cash generating unit, together with all of the assets that make up your activity for revenue creation. Are they tested for impairment individually, or are they tested for impairment by including them within the cash generating unit? I'd like to encourage, oh, thank you, and you got it right. Wants to submit an answer to do it in the next 10 seconds, please. One. Two of you got it wrong, but nearly right. I mean, certainly A, we know is wrong. That's fine. B is the regime that we use for intangibles. Remember, IS 36, a birthday test, and equally for goodwill, a birthday test. That's not the right answer. It is in fact the correct answer. You test them for impairment when there are indications, but you do each item of capitalized cost independently, rather than rolling them up with all of the other assets that generate revenue. Generating unit type approach, which is described in D, it's single unique assets, which are tested for impairment. So you got it right. Two of you selected D. You're nearly there. You're nearly there. Slides for today. The standard then became mandatory from the 1st of January 2018. Hopefully you have been on and on and on at your clients to get prepared for this. Earlier application was allowed, but in fact we didn't see any, well, I haven't seen any publicly accessible examples of early application. There were two methods, and this is still relevant because although we're in the transition year, you're nowhere near publishing the financial statements for that year of transition. Typically it'll be December this year. So there are two methods, either a full retrospective restatement or prior period described in IS 8, expedients that are described in paragraph C5, or retro, but at the beginning of this year, 1st of January 18, with a cash statement at the beginning of the previous year, or retro, So as if it's always been done this way, but the catch-up at the beginning of this current year. Additional descriptions in paragraph C7 and C8. Which is, I guess one might have to say, the most preferred method, because it is going to give full comparability between 2018 and a restated 2017. There are a number of expedients. You can choose which ones you want. For completed contracts, an entity does not need to restate contracts that begin and end within the same accounting period. For completed contracts that contain variable consideration, an entity can use the transaction price at the date the contract was completed, so you can do your catch-up in one go at that point. And for all reporting periods presented before the 1st of January 18, you do not need to disclose the amount of the price that is allocated to remaining so-called modified retrospective application is where you have to catch up at the 1st of January of probably this year, the year that you actually implement this standard. If standard retrospectively with the cumulative effect recognized at the date of that initial application, recognize the cumulative effect as an adjustment to retained earnings, presumably, period. So the period commencing 1st of January 18. Under this method, an entity must apply this standard retrospectively only to contracts that are uncompleted at additional disclosure, which each line item in this year, in 2018, has differed, have had in IS 11, 18, IFRIC 13, IFRIC 15, IFRIC 18. So the problem I see with this modified retrospective, you're going to leave last year exactly as it was, IS 11, 18, and so on. You're going to have this year as IFRS 15. And how much would this year have been different by if we had carried on with the old standards? And the problem with that, I think, is most of us, and I think the same is true for you and your clients, if you've got to introduce something new, generally speaking, you want to get rid of it rather than have to keep running along with effectively a continuation this year now of now dead and defunct. So as a sort of a psychological type problem that you can't get on with the new and throw out the old. And numbers are different to what they would have been. Significant judgments needed, particularly in the cases like the patient at the emergency room and so on, with questions around whether or not a particular transaction is a contract or not, is it therefore within scope or not, and the process of continuously reviewing that circumstance. That's, I think, quite a significant issue. We've seen three very good examples about distinct goods and services. But it's still, I think, an attitude of mind that will be new to many of you. But it only becomes a real issue when it's into the middle of perhaps a sequence of deliverables. Measurement of variable consideration has always been a problem. Issues of rebates and discounts and penalties and bonuses, we always had to find some way of dealing with them or ignore them completely. Now, ignore them completely, but there is an overriding judgment that the risk of a significant reversal where themselves has to be reduced to a pretty small risk. Becomes a little challenging. As we've had in the past, about whether or not a contract contains a significant financing component. Yeah, how many extra days of credit do you offer the significant financing transaction? They have to be estimated. The standard describes how to do that. I mean, we've not dwelt on it today, but there is a process described where you cannot directly observe standalone prices. A problem that we'd always have to face up to. It's no easier. It's not any more difficult either. It is just the reality that when you're doing work that spreads over a number of years in some sort of continuous process, most construction contracts, you have the challenge of measuring completion. Well, 10 o'clock precisely. Thank you with me. I expect to see you all again in the middle of June, where we'll be focusing on disclosures and the so-called disclosure initiative projects. Quite a variety of them. June the 14th or 15th, I think. Have a good day, and thank you very much for being with me. Bye-bye. The recording of today's webinar will be available on the Creston intranet, I guess, probably at the end of this week or early next week. Thank you very much. Bye-bye.